So now I'm going to try and answer as best possible this very broad question. What is cryptocurrency? Well, the easiest way to put it is it's digital cash. Okay, it exists only in the form of digitization. Okay, so it's not created to be physical. It's not something you can touch, you can smell, you can give to somebody else and therefore spend it. It's purely digital. And all transactions happen via what's called a blockchain. Now, it's decentralized, which means it's independent of banks. You own it. That's the difference. You own it. The bank doesn't own it. You own it. You are the central entity when it comes to ownership of your money. Now, it's stored on the digital ledger, which is known as the blockchain. Okay, the blockchain is a record of all transactions. And basically, there is a distributed network of people running computers which act as the consensus. Okay, so all of these digital computers will agree that you have sent money from one party to another, and then that transaction will happen. Now, you own that cryptocurrency based on a private key. That private key is what owns the cryptocurrency. So decentralization is at the forefront of cryptocurrency. Okay, so it removes third parties. Okay, this gives more trust. How much can you trust banks? The trust in banks and centralized entities is dwindling and going. Okay, so let's just have a look at two main central entities, banks and Facebook. Okay, two different types of centralized entity, but they show why you may not want to trust them. So with a bank, when you are storing money in a bank, they use that money to trade. They use your money to trade it and make more money. Facebook, they say you own your data, but actually they own your data and they can sell it to third parties, which is something that they have been accused of. So really, these entities lie to you. They make you think one thing, but actually in another aspect, they're doing something else. So with decentralization, you own the asset. Third parties are removed and third parties can't take a nice chunk out of your money. Now, there are two types of supply when it comes to cryptocurrencies. Okay, so for instance, Bitcoin has 21 million coins out there. Okay, so there's 21 million that are going to be eventually mined. Okay, so how it's mined is through miners. Okay, so they are mining the supply. They are creating the supply on a daily basis. And then there's minted supplies. So when you are creating a cryptocurrency generally, you decide what the maximum amount is and you can produce it on demand. Now, cryptocurrency in itself is viewed as an asset class. I've spoken about it as an innovation in technology, but really many people view it as an asset class. So like the stock market, stocks. Stocks are an asset class. You invest in them, hopefully the price goes up. And they are spendable. That is one of the myths of cryptocurrency. People don't know. You can actually spend your cryptocurrency. So if you've got 3 Bitcoin, you can spend that currency online, and there are more and more mechanisms being developed where you can spend it using a cryptocurrency debit card. And that converts the Bitcoin into fiat currency, which is basically what is currently known as money, fiat currency. So that's dollars, pounds, euros, yen, all of the different currencies is known as fiat. And that is how, merchants accept money, which is, in the form of fiat. So when you are spending it at the point of sale, although it comes out of your debit card as a bit of Bitcoin spent, how the merchant gets it is fiat. So it's a perfect system. It's the system integrating with what's out there at the moment. And you can see it works. So that is cryptocurrency. In essence, it's digital cash that is decentrally stored. You own it via a ledger. So I hope that has explained it, and I'll see you in the next lecture.